Hello everyone, welcome to this session of In-Depth Economics. In today's tutorial, we are going to study different methods of measurement of national income. How we are going to approach this topic? Of course, in a slightly different way. First, I'll show you a clip. You watch and observe what activities are happening on the clip. Then we will associate those activities with today's topic. Yesterday, I visited a supermarket. I wanted a pack of yogurt. It cost 4,650 Korean won.
만 10원. 네. 포인트 있으세요?
없어요.
예, 언니 감사합니다.
감사합니다.
Can you guess how much did I spend on these 5 items? 10,010 Korean won. That's something interesting, isn't it? So, my expenditure of 10,010 Korean won was income for the supermarket. Why did I spend 10,010 Korean won? Because that was the value of the products that I have purchased. So, production value is also equal to 10,010 Korean won. The same thing holds true for an economy. This can be expressed in the form of an identity, which is national product is equal to national income is equal to national expenditure. There are 3 ways of measuring the national income of a country. They are from the income side, the output side, and the expenditure side. We can classify these perspectives into the following methods of measurement of national income: product method, income method, and expenditure method. Under product method, we add the values of output produced or services rendered by different sectors of the economy during the year in order to calculate the national income. Under income method, we add all the incomes from employment and ownership of assets from all the production activities in an economy. Expenditure method measures the total domestic expenditure of the economy. It consists of 2 elements, which are consumption expenditure and investment expenditure. Now let us understand the production method. The production process of a good or service involves different production units. The production method shows the value added or contribution of such units. Every production unit adds some value to a final product, and for its production, it purchases some intermediate goods from other firms. To calculate the national income of an economy, the value added by each of these individual firms to the final product is summed up. Thus, this method is also known as value added method. We can calculate value added by individual production units by using this formula. Value added is equal to value of output minus value of non-factor inputs. Now, what are non-factor inputs? Non-factor inputs includes all factor inputs other than land, labor, capital, and entrepreneur. In other words, it includes all raw materials used in the production process. For example, let us suppose there is a baker who requires only flour to produce bread. He purchases flour from the miller worth rupees 30, which will be the intermediate good, and uses it to produce bread, which will be the final good. He sells bread for rupees 50. Thus, the baker has added a value of rupees 20, that is 50 minus 30, to the flow of final goods and services in the economy. So, to calculate national income of an economy, first of all, the gross value added of all different sectors are calculated and then added together to arrive at GDP at market price. The formula for calculating GDP at market price is GDP at market price is equal to gross value added at market price of primary sector plus gross value added at market price of secondary sector plus gross value added of market price of tertiary sector. Now that we have the value of GDP at market price, we can calculate national income, that is NNP at factor cost, through value added method. The formula used for that is national income is equal to GDP at market price minus depreciation minus net indirect taxes plus net factor income from abroad. Now let us look at income method. Production of goods and services involve the use of land, labor, capital and so on. And if we consider these factors of production, income is generated via rent, wages and salaries, profit and interest. We can then calculate national income by adding all this type of income. Another important source of income is mixed income. What is mixed income? Mixed income refers to the income generated by self-employed professionals and sole proprietors like doctors, lawyers, accountants, etc. Using this method, we can calculate NDP at factor cost. Income method, however, does not consider transfer payments, prize money like lotteries, illegal money, profit taxes, and sale of second-hand goods. Now we come to the third method, expenditure method. Expenditure method of calculating national income focuses on the expenditures. Now, expenditure refers to all the purchases made by residents, governments, or business enterprises. The expenditure method takes the following element into consideration: purchase of consumer goods and services by residents and households, denoted by capital C; government expenditure on goods and services, denoted by capital G; business enterprises expenditure on capital goods and stocks, denoted as capital I; and net exports, which is nothing but the value of exports minus import, and this is denoted by capital NX. So, according to expenditure method, national income is calculated using the formula national income is equal to C plus G plus I plus NX. Expenditure method is the most common way of calculating gross domestic product of a country. I hope all of you will find today's tutorial useful. Please share and like the video and subscribe for more content.